All right, guys, good morning, afternoon, or evening, wherever you're located in the world. Thank you so much for taking the time out of your day to be with us. My name's Aaron Hill, and I am one of the market analysts here at FP Markets. As a brief intro, I've been a chartist for more than 12 years now and remain, shall we say, obsessed with price action and chart psychology. I've also completed CMT levels 1 and 2, and I'm currently on the final level 3 as we speak. So any questions on the course, please feel free to ask away. Now, I assume, given the chat box is relatively light, we can all see and hear me clearly, and the welcome slide is visible. Okay, excellent. Oh, brilliant, thanks guys. Okay, so while I usually conduct more of, I guess you might say, educational webinars largely on technical analysis, today's session will take a somewhat different path. Just give me a second, guys. A different path and solely focus on market analysis. I know as traders we all have our own way of looking at markets, and therefore some of what I show or say you may not agree with. But I think this session will be of benefit to newer traders looking to, shall we say, get their feet wet and are looking for ways to navigate markets. And to round off the introduction, please note that a recording will be available of the entire webinar will be available, freely available, should I say, to all of us, either through the main FP Markets website under resources, or alternatively on our YouTube channel. I'm going to sound like a typical YouTuber now, but if you want to catch all of our latest videos, be sure to hit the YouTube subscribe button. Okay, next up, we have to quickly zip through the disclaimer. So look, the information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. FP Markets has made every effort to ensure the accuracy of the information as at the date of publication. FP Markets does not give any warranty or representation as to the accuracy, reliability, or completeness of the information contained in this material. So, guys, look, really, the long and short of it is what I'll be discussing in this presentation involves trading setups, and I must make it clear that they are my personal opinion based on my experience and knowledge. I also have to be clear, this is for educational purposes and is not investment advice. So please always ensure you do your own research. So with that in the rear view mirror, let's get the ball rolling. Just a quick heads up, there'll be only a few slides in this presentation to go through today. Most of the action will, will of course involve charts. So first up is where we stand in the markets right now. So look, here I intend to look at a couple of key instruments to get a feel of what's happened overnight UK time. And I'll also take note of any tier 1 economic data scheduled for release. For this, you can simply use the FP Markets economic calendar. But guys, look, I know already we have a relatively light economic calendar today. So if it's okay with you guys, I will sidestep this part. I'll also be noting where we stand in the bigger picture from a technical standpoint, as I'm unsure of the experience levels we have here today. I will try to simplify things as much as possible. Though anything you're unclear on, as always, just place your questions in the chat box and I will get to it as soon as possible. Sorry guys, I'm just looking at the questions right now. We have a question, can you please show us how your daily trading routine? Yes, Jim, no worries. We'll get to that. There's a question here about whether the webinar is recorded. Yes, Anthony, most definitely. It's, as I said at the beginning, you might have missed out, I'm not sure, but we've got a recording available on the main website under resources, and we also have a recording on our YouTube channel. Also, support will send you an email following the conclusion of this webinar. Excuse me. So yeah, I can see a few guys listing some currency pairs. Excellent. We'll get to them shortly. So the next port of call would be observed levels. So at this point, I'll rummage through the charts to see if there are any areas buyers and sellers may be drawn to. Here I'll attempt to nail down areas of confluence, which I'm sure most of you guys will be aware. It essentially means points on the chart where multiple technical tools merge. And finally, we'll look at requesting charts. This is where I'll open the floor to any charts you feel could be noteworthy. But to be honest, look, we'll likely cover most of this in the second section here anyway. Risk on. Will good day guys. Thanks. Risk on. Will US 10-year up or down, and why? I'll check out the US 10-year in a minute, Lucas. Just give me 2 seconds. So, look, I hope you don't mind, but I thought before we get things underway, I will take this opportunity to clear up a truckload of confusion surrounding Fibonacci structure. I've seen many websites advertise incorrect. Well, I have to be careful with the word incorrect. Well, not textbook formations, and therefore it can cause confusion. I'm not saying we all do not use fibs in our own way. I know we do, and I know we adapt things to suit our trading personalities and trading styles. But especially for any newer traders here, I think it's important to demonstrate textbook configurations before looking at adapted styles. So you'll have to excuse the artwork, but I think it's enough to get the main point across. Also, once I'm done with this slide, I will share this in the chat so you guys can review it at your own leisure. And look, guys, please do email me any questions on Fibonacci structure. I'll ping across the email very shortly. Any questions on Fibonacci, please do send me an email, and I'll hopefully help you clear up any confusion. Right, so kicking off, we have 4 main Fibonacci patterns to consider: the retracement, the extension, the expansion, and the projection. So Fibonacci retracements work equally well on, one second, guys, I'm just checking out any questions. Okay, I'm just going to close the question box for now, so I'll go through this, and I'll check out any questions at the end. So look, first up we have as I said, Fibonacci retracement, and these, I have to say that these work equally well on any time frame if there's a distinct move from a swing low to a swing high, or vice versa on that time frame. Just to note, I've not seen any reason, as I just said, to believe that fib tools cannot be used on all time frames. When I say all time frames, I'm meaning from the 1 minute time frame to right up to the monthly time frame, so the longer term charts. So look, quite simply, a fib retracement tool can be applied, assuming we're in an uptrend. Assuming we're in an uptrend, from the higher low to the higher high. So the higher low is point A, the higher high is point B. The tool will then section off. Defined fib retracement levels at these points here to look at as price retraces. So when I say defined retracement levels, I largely focus on the 38.2% and the 61.8%. But guys, there is the 78.6% and also the 88.6%. They're much deeper retracements. There's also the 50% retracement, which is not technically a Fibonacci number. It's something that I've seen price react to, but though, as I said, it's not a Fibonacci format value. So next on the table, we have what's known as Fibonacci extensions, which I see a lot of confusion on websites, and a lot of traders using it incorrectly. But as I said, we all have our own way of doing things, so I'm not here to say that anything's incorrect. I'm just trying to give you the textbook arrangements before we look at adapting things, as I said. So Fibonacci extension. which is essentially plotted in the same direction as the fib retracement tool. So it's an extension of the fib retracement, and like that, it only needs 2 points from A to B, as we had here. These are so as I said, we're extending past the Fibonacci retracement barrier, which is so from the higher, I'm just trying to think of the best way to explain this without confusing. So the higher low would be here, the higher high would be here, and we apply our Fibonacci retracement tool from this point to this point, and these are the levels that are extended past the Fibonacci retracement higher low at this point here. Okay, and for me personally, guys, I only focus on the 1.272% and 1.618% extensions. I know some other patterns do focus on the deeper levels, but for me, I tend to focus just on those two values. And to the right of things, we have what's known as the Fibonacci expansion. Look, I'm sorry if I've confused you guys with this. Hopefully, with my explanation, it will become clearer. So like both the retracement and extension formations, the expansion tool also only requires 2 contact points. So when I say contact points, I'm talking about the A and B. So it's very similar to these two here, 2 contact points. So this would be a higher low, and this would be the potential higher high. Why I say potential will become clearer in a minute. So a Fibonacci expansion tool essentially goes in the direction of the original price move before the retracement. So we do not necessarily need the retracement to form to plot a Fibonacci expansion tool. So it projects probable price levels in the event of a continuation from point B. So what I'm saying is we do not necessarily, as I said, we do not necessarily need the retracement to project. As I said, I've got to be careful with my terminology here, project levels at point C. So for me, I use the 1.272% fib expansions and the 1.618 expansions. We essentially, so just to try and help you understand this, we essentially apply the fib expansion tool to the higher low at point A, to the drag it to point B, which is the possible higher low, higher high, sorry. But obviously we won't know that until a retracement's formed. But as I said, we don't need a retracement to apply the Fibonacci expansion. So let me just go over that again. So we begin at the higher low, we drag the Fibonacci expansion tool to point B, and then drag it back to point A. So look, I guess you could really say we need 3 contact points for this. So drag from point A to point B, back to point A. Look, I've seen many traders use expansion and extension interchangeably, but they're opposite formations, as you can see here. So please do keep that in mind when you're using them. And finally, we have the Fibonacci projection. Now, I think these are used in AB equals CD formations. These are harmonic structures, guys. So though when applied to these patterns, they're often called extensions, which again could cause confusions. But look, everyone has their own way and everyone has their own terminology. I'm just trying to provide you with textbook structure. Anyway, the fib extension, the fib projection actually requires 3 points of contact from the higher low to the higher high to another higher low at point C. Unlike that of the Fibonacci expansion, which takes the length of A to B to show possible price levels higher up in the curve, the Fibonacci projection measures basically the length of A to B from point C. Whereas, yeah, so look, I hope let me just check the question, see if how many people I've confused. Oh, excellent. Okay. I have a question. Jordan, fire away with your questions, friend. Please do. Ah, excellent. So, guys, is this clear for you guys? Just if not, I'll go over it really quickly again because I want this to be clear before we move on to some charts. because I'll be talking. Hopefully, I'll be talking about fibs. Excellent. So a lot of people are saying it's clear. Excellent. As I said, right, guys. So what I'll do, go over this in your own time. And as usual, any questions, please fire them over to the chat box, and as I said, I will address them as we proceed. The main point I wanted to get across was the confusion between extension and expansion. A lot of traders, so many traders, obviously haven't read any books on Fibonacci studies. I'm going to recommend 2 books. I actually, yes, I will show this on charts, no problem, I will show this on charts. But it's shocking because there's so many traders structuring Fibonacci on forums, and they clearly haven't read any books on this stuff, because they're showing it incorrectly. And there's only a few traders I've seen that actually do plot this within a textbook style. Yes, what advice? So we have a question. Yes, what advice would you give to someone who's just learning trading as a beginner? You know, that's a very deep question there, Jordan. What advice? So for me personally, if it was me starting again, I would firmly recommend looking at psychology of trading, wholeheartedly. Actually, looking at the psychology of trading. They say that it's 80% psychology and 20% method, but I agree and I don't agree with that, because there's a lot of work that goes into understanding the markets and understanding how they function. So for me personally, I would have started with psychology to understand how you can potentially handle losses. It's a big thing. Not a lot of us can we? Not a lot of us can handle losses. Not a lot of us deal well with losses in. The thing with trading is you get hit from 2 sides. You get hit from the losses, and you get hit from being wrong. Not a lot of us like being not a lot of us like being wrong, and not a lot of us like losing money. So you get hit with a double whammy, should I say? So 100%, I would say. 100%, I would say look at psychology for me personally. Then move on to price action. I absolutely love price action. If you're considering technicals, and also would look at fundamental analysis as well. A lot of technicians seem to sidestep this, me included at the beginning. So for me, I would go in that formation. I would go for psychology, then look at technical formations. Then I would have then I would look at fundamental analysis and try to merge the 2 together. Right, so just give me a second, guys, and I'll put this slide in the chat box for you. Just give me 1 second. Hopefully this goes in. No, it's not. Right, so I don't think this is going. Can't put the image into the chat box, unfortunately. So what I'll do is I'm not sure. Guys, if you're interested in the slide, this is an easier way. If you're interested in the slide that this slide for the Fibonacci, fire me over an email, which I believe is in the chat box right now. Let me just see. I'll ping across my email in the chat box. There it is, guys. So marketanalyst@fpmarkets.com. So guys, if you're interested in this slide, I'll ping it across. I'll reply with this image. For some reason, I can't attach it to the chat box. So look, I'm really sorry for diverging somewhat here with the fibs, but I feel it will give newer traders a foundation to build with, to build something with. If you're interested in Fibonacci, yeah, that's a good idea, Julian. Get everyone to take a. Anyone that's interested, also, guys, take a screenshot of this slide, and it's yours. Print screen. Yeah, very good. Thank you, guys. Didn't think of that. Right. So look, as I said, I'm sorry for diverging with the fibs, but I really feel it's something traders need to newer traders need to understand before adapting the structure. Also, if you're interested in extending your fib studies, consider checking out Caroline Borden's fib book titled Master Time and Price Advantage. Actually, just let me throw a link across to you guys, because this was this will emphasize what I've just shown on these slides. Hopefully this comes across. Yep, there's that one. And also one other book I would recommend is what I was given to by my mentor when I was trying to understand Fibonacci, is Kane Trading on Advanced Fibonacci Trading Concepts. Just give me a second, guys. Just give me 1 second, guys. I'm going to try and get this across to this slide across to you guys. Okay, and as I just said, let me just get back to that. As I said, there's one other book called Kane Trading on Advanced Fibonacci Trading Concepts. I'll also throw this link across to you guys. Look, they basically emphasize the same things. I think Caroline Borden's work focuses more on Fibonacci, I forgot what they're called now, where they converge. So Fibonacci clusters, that's the word I'm looking for. Fibonacci clusters, that's where Fibonacci levels converge at roughly the same price level. Just Google Fibonacci cluster and then you'll see what I mean. But there's something I would definitely consider looking at. It's something I use in my analysis on a daily basis. So yeah, hopefully, guys, when I talk about fibs now, you'll have a deeper understanding with this. So now over to the markets. Where do we, let me just click across the slide, where do we stand in the markets right now? Right, I'm just going to spin across to the charts. Hopefully you guys can see all my charts. Just ping in yes or no if you can see the charts. That'd be great. I just don't want to be talking to myself about something that's not on the screen. Excellent, thank you, guys. I see a few questions coming up. I'll get to them as soon as I can. All right, I just want to get through a few of these points before I open the floor to more questions. So look, as you can see on the charts, as you can see on the screen, I have the US dollar index. I always kick things off with a look at this instrument on the daily scale. I sometimes will check out the H4 chart as well. For those who do not know what the US dollar index is, it's simply a measure of the greenback's strength against six major foreign currencies, which are the euro, the Japanese yen, the British pound, the Canadian dollar, Swedish krona, and the Swiss franc. I must note that the euro has the biggest weighting within the index of, I think it's around 58%, 57.7%, I think to be exact. But look, this is a really handy instrument to have on your charts, and it is something I would wholeheartedly recommend. I have a question here. What is Quasimodo? Lucas, please check out we did 2 webinars on the Quasimodo pattern. Please do check them out. I'm going to go over them in the analysis very shortly. But yeah, if you're really interested in the Quasimodo formation, which I think you should be, if you're interested in support and resistance on the charts, I'm still unable to access the webinar links. Maybe speak to the support team, Lucas. They might be able to help you with that. I'm not sure. It's under the resources tab on the main website, or failing that, go to YouTube. They're all on YouTube and they're easily accessible through that. Just search FP Markets YouTube and you'll find the uploads available there. So as I said, look, guys, I always focus on the it's called the Dixie. That's the ticker symbol, the US dollar index on the daily chart. So look, I'm going to go over this chart really quickly. As it gives us a position where we are with the US dollar, which is a major currency, as I'm sure you're all aware. So look, as you can see, we have a descending wedge that's formed, right? A descending wedge is a shape, exhibiting a decrease in downside momentum within its walls. So they're converging trend line, downward facing. I don't want to say trend lines, converging descend. Oh, excuse me, guys. Converging descending lines. As you can see, they converge. Well, they don't really converge. This wedge shouldn't really converge at the edge. But anyway, so this is between 91.43 above here and 90.42 low, if you want to ping that on your own charts. So look, as we know, price topped out at the 93.43 31st of March peak, and you know, it's cooked up a reasonably decisive downside movement. The recent pattern formation here. Just let me be clear. So a descending wedge can for me, it represents either a continuation pattern or a reversal formation. So given the reasonably decisive movement to the downside, this descending wedge for me is a potential reversal signal. As you can see, last Tuesday, we actually retested the upper boundary of this pattern. This is quite common to see. So once you get a breakout, we had the breakout, let me zoom in, we had the breakout around this point here, and we followed through to the upside at this point, and we retested it on Tuesday, last Tuesday. And that's developed support, which led to 3-week peaks at this point here on Friday at 90.62. Despite Friday finishing on the ropes. You know, the end of week decline, as I'm sure, look, most of us are aware, formed in response to May's lower than expected US non-farm payrolls count at 559,000. The consensus was 650,000, around in that range. And this was despite Thursday's gauges, the ADP National Employment Report and the US initial unemployment claims, demonstrating, you know, a somewhat optimistic vibe, which hauled the buck to higher levels. So look, for me, clearly the markets were anticipating more out of the Friday's NFP report. So look, back to technicals. Just zoom out. The pattern's upside target for a descending wedge is measured by the base distance from the high to the low at this point. As you can see, formed by these small rectangles here, and it's extended from the breakout point at this point here. So as you can see, we price could potentially rally as far as, I think it's 91.31, which, as you can see, is just south of resistance at this point. Now, why is this a resistance? You might just say that there's 2 points here, but if you look closely, this was actually a Quasimodo support. So a Quasimodo support, the low, high, lower low, higher high. And we come down and we failed at the Quasimodo support. Now, if you remember from the Quasimodo sessions we've had 2 of them now, I look for a clean break. I look for a clean break with no upper shadows touching the level. What happened was we broke the level, we retested the level, formed a what's known as a shooting star pattern at this point here, which is a bearish signal. Which is considered a bearish signal, especially at resistance and at peaks. And then we followed through to the downside and subsequently retested the level at this point to form the descending wedge. Now, so as I was saying, we have the take profit target for the descending wedge plotted nicely below the 91.36 Quasimodo support term resistance here, and also the 200-day simple moving average at 91.60. Circling around this area. So this is quite, for me, this is reasonably formidable resistance, which if we do rally this high, rally as far north as this point here, we could see a bearish reaction. Now, why do I think that? Aside from the resistances plotted at this area, the reason I believe that we could see CT sellers make a show at this point is because of the overall trend. Now, if you look, we topped at, I think it's just south of 103 at the height of the pandemic in March 2020. And we formed a bearish narrative. Look, this has clouded the greenback since, as I said, since the early months of 2020 by way of clear-cut lower lows, lower highs, lower lows, lower highs. And this defines your downtrend. Many analysts, I believe, will note this as the primary downtrend, especially on this time frame. Consequently, this unlocks the possibility of fresh lower lows beyond support at 89.34 here, which means pushing below this level to possibly attack Quasimodo support at 88.50 89.43. Look, so should an extension of the current pullback from 89.53 emerge over the coming weeks? A bearish scenario, should I say, in line with the current downtrend, could unfold off the 91.36 resistance. Look, at the same time, so failure to explore higher levels is obviously a possibility. We could just test this support, which, you know, given the current trend and the lack of forming clear-cut higher highs above this lower high here, this support for me is quite a vulnerable area, and is likely to break, even though albeit we may see a minor attempt to hold the level. So with that in mind, I wanted to highlight something else just on the monthly time frame, just to emphasize this current trend we have on the dollar. If you look right out to the monthly time frame, which I'm sure some of you traders do watch, we also have a clear-cut downtrend in motion here. We have I'm not sure of the data here because that's right back to 1985. So we have the lower low, the lower high, the lower low, and now we're forming potential lower highs. Now what's interesting at this lower high is it's helped, I believe, by the 61.8 fib at around 101.55-ish. And also for any chart pattern traders, you'll note a potential double top here. Now, I'm sure you're thinking the double top should be joining highs. Yes, I agree, but I think within textbook style, it should be within 5%, and I think this is within 5% of each other, the peaks. Now, if we break I call it a neckline, the trough between the two peaks at this point here, we could potentially be going much, much lower on the dollar, which, as I've already said, converges with the daily time frames possibility of reacting off this level or just simply draining through this support here. Now, guys, any questions on the Dixie? Because that's where I stand currently on the US dollar index. I see no questions. Either I've confused everyone or it's just so we expect bond price to go further down. This is not the bond market, Daniel. So clear. Excellent. Thanks, Kevin. Okay. So right. So I'm going to move on. Yeah, no problem, Daniel. It's okay. So yeah, I can't say that the dollar index will continue lower, obviously, because no one knows. But according to the charts, it looks like that the bears remain in control. So what that means for major currency pairs like the euro, which, as we've said, as I've already said, contains a huge weighting in the dollar index. That could mean that we're heading higher on the euro, which we're going to take a look at in a minute. So, as I said, that's where I am with the US dollar index right now. Of course, you could go into much more detail here. You could go down to the lower time frames like the H4, H1, M30, M15, but that's down to the individual trader. I'm quite happy with the daily time frame on the dollar index for me. So following this, I would check out where we stand in terms of potential risk sentiment for the day. Now, guys, risk sentiment. I hope most of us have a basic understanding of what risk sentiment is. I'm going to go over it just briefly, just in case for newer traders. So risk sentiment is a term used to describe how traders and investors are essentially feeling or willingness to take risk, if you like. So with risk sentiment, you'll often hear the terms risk on and risk off. If memory serves me correctly, I think these terms were invented by news stations in order to help viewers understand what's being shown. Anyway, when the market is optimistic, it is considered a risk-on environment. A risk-on mood refers to, the willingness of traders and investors to essentially take on more risk. So telling us that traders and investors are more confident in buying riskier assets and over what's known as the safe haven assets. So risk assets. So some risk assets are stocks and higher yielding currencies. So when the market is seeking safety, it is considered a risk-off environment. This is a setting where the market tends to shift to safe haven status, safe haven assets, as the best way to preserve capital during periods of what's known as risk aversion. So look, some examples of safe haven assets include US government bonds, you know, the bills, notes and bonds, the Japanese yen for currency, the Swiss franc, and the US dollar at times, and also gold as well. For stock traders, companies that are part of healthcare, you know, the consumer staples are considered as safe haven or defensive assets. This is because companies in these sectors provide products that people need, regardless of the economic landscape. One final point: keep in mind that shifts in risk sentiment can happen gradually or quickly. You know, markets can move from markets can be in risk on mode for days, you know, months, weeks, only to quickly shift to risk off mode within a heartbeat. This is just my perspective, guys. So look, how do I measure risk sentiment personally? Let me just switch over to the risk chart. I hope these charts are reasonably clear. So look, my first port of call is to check out the E-mini, the S&P 500 E-mini futures contract using the front month contract, which means the nearest expiration date. So I use the futures market as the cash market is still closed in the US, opening for me in the UK, and it opens from 9:30 a.m. to 4:30 p.m. Eastern Standard Time, which means, you know, for me and most Europeans, I guess, it opens early afternoon, but for me it's 2:30 p.m. 2:30 p.m. Eastern, British Standard Time. So as I'm sure most of us are aware, the three most widely followed indexes in the US are the S&P 500, the Dow, that's the Dow Jones Industrial Average, and the Nasdaq Composite. Though you know, I'm sure you've seen most of these indexes tend to largely move in unison. So I mainly stick to the S&P 500. So look, without going into too much detail, if stock indices trade with a positive tone, then a risk-on vibe is on the table. Conversely, if stock indexes are lower on the day, then it's considered risk-off. Bond yields would also be another watch of mine, and then I would quickly switch over to the VIX. Now, look, I can go over these indicators, but that would likely take up a lot of our time. That would take up a lot of our time to go, and we don't really have the space to go over each indicator in detail. Look, if this is something you would be interested in learning about, or you know, or developing your knowledge with these indicators, please do let us know, and we'll create a specific webinar, a presentation on these indicators, because a lot of newer traders are unaware of what these mean. So look, for now, since the pandemic low of March 2020, the S&P 500 futures market has been in a clear risk-off tone, right? So a long-term risk-off tone, and you know, the S&P 500 has been continues to make record highs. I haven't checked out the Dow or the Nasdaq, but I'm pretty sure that they'd be very similar to what the S&P is showing. So look, guys, I'm going to switch over to the charts as time is of the essence now. And so when I say charts, I'm talking about the FX charts, the Forex charts. So let me just begin with the euro dollar. I see some guys did ask to look at some markets as we start. Guys, if you can ping over any markets you're interested in looking at technically, why am I using the SPX E-mini? The reason I'm using the E-mini futures contract is because, as I said, it's the cash index is not open. When I say the cash index, I'm talking about the main equity index. It's not open in the US, right? It opens at 9:30 a.m. and I'm based in the UK, so I have to follow the futures contract, which trades practically 24 hours a day and can provide a good indicator of where we're going to open on the main US on the main US cash equity indexes. Okay, so I'm just going to run through these charts just really quickly. So for the euro, as we can see, we are bouncing off a higher time frame monthly support zone, 1857, 1352. For guys that are regulars here, will have seen me go through these already. So look, I'm going to put it to you guys. If you would prefer me to look at charts that I haven't prepared or anything like that, actually, one thing I do want to point out to you guys is Bitcoin. As we all know, just real quickly, as we all know, Bitcoin has been in a downfall since since mid-May, and we also I pinged across this on the FP Markets Twitter about a pennant pattern forming. So we have a clear lower leg with the pennant pattern and a clear consolidation forming. Don't confuse these with the AB equals CD patterns. I saw a comment with someone confusing these with the AB equals CD formations when it's not. This is a triangle formation, a continuation formation as well. Now, with the breakout lower, technically we could be heading as far south as $6,000 mark. Now, don't quote me on that. This is just what the pattern's telling me. Another way you can actually project pattern targets. So the textbook way of projecting pattern targets is taking the distance between the preceding leg, so from this point here to this point here, and simply extending this from the breakout point. However, a lot of traders I've seen use it like this, me included actually, because I find that they reach the targets much easier because it's less of a distance to reach. So what you can do is extend this, and so we have two targets essentially, for me anyway, from this point to this point. But this is not textbook. Textbook is the longer version to this point here. Okay, so we could potentially drop down to the $18,700 level with Bitcoin. If for any Bitcoin traders here anyway, that I thought that might be handy. So let me just go over the, don't confuse the log charts and arithmetic charts. I'm not confusing log charts and the arithmetic charts, Julian. this is a pronounce it, arithmetic chart, this one. I don't use log charts at all. They're mainly for longer term charts. I'm not sure if that's what you was referring to. Anyway, let me just quickly go over the euro dollar, where we're positioned. So as we know, we're potentially near 2021 peaks on the euro dollar, bouncing from a clear-cut support and resistance area, and we could potentially touch this ascending line here. Right, so this is the line in the sand for me, the Quasimodo resistance at 2278. As I said, this is Quasimodo resistance, so price could potentially test here and produce a mild, reaction, but ultimately, according to the monthly chart, we are heading higher. On the H4 chart, I recently highlighted a potential. This is where the Fibonacci gets a little bit confusing for some people. 1 second. Just give me a second, guys. Sorry, guys. Just trying to this. Okay. So, as I said on the H4 chart, this is where the Fibonacci becomes a little bit more apparent. So, as we can see, we have a Fibonacci retracement for the 61.8% taken from this clear-cut higher low here to the higher high here. Of course, you could add additional Fibonacci retracements from this high low here to this higher high, but I didn't. We also had a 100% Fibonacci projection, which, as I said at the beginning of this webinar, we need three points from this point here to this point here to that point here. Now, for harmonic traders, For harmonic traders, this would be considered the AB equals CD formation. And as you can see, we did react nicely off that area. I drew the green box to obviously include the 61.8%. So this was the area of support. As you can see, we have reacted nicely from this, and we bounced up to the 38.2 Fibonacci retracement of legs A to D of the A, B, C, D formation. So for any harmonic traders here, I'm pretty sure we'll understand a typical target for the AB equals CD. I think this was highlighted by Scott Carney. Do check out his work if you're interested in harmonics. The 38.2% is an initial target, and that was at the 2167 mark, followed by the 61.8% Fibonacci retracement level at I think it's around 2206. So as you can see, we have just missed that, and we've slightly retraced, and we're now retesting the top edge of this area here. So well done to any guys that caught this move. It was a very nice, very clear-cut area of support. Yeah, so there's also on the, what was interesting was we had some Fibonacci levels, I think it was, yeah, I'm not mistaken. Okay, so this was where I was. So as we can see, we've recently broken the trend line resistance here. As you can see, trend line resistance turns support. Now with this in mind, we've bounced off the 122. Now, if you read the market analysis I provide daily, I said that we could potentially find some active short-term sells, we could find a potential bearish scenario form here. Short-term, I'm talking here, because we have the 22 psychological level, a resistance plotted just above it at 2211. And if you remember from the H4 time frame, we also have the H4 AB equals CD 61.8%, 2206 level plotted in between. So this for me was a reasonably, tight area of resistance. So with that in mind, we know we're retesting this 100 period simple moving average. I still believe we are going higher on the euro. I believe this is going to be an important zone for the euro dollar. But as I said, we could potentially even pull back to this support here at 2132, which converges with the trend line resistance turn support. Now, any questions on the euro dollar? No questions as far as I've seen. Julian, if you could just elaborate on what you mean by don't confuse the log charts and arithmetic charts. I'd be interested to know what you meant by that, because I've never used the log charts before. I know from studies that they're used on the longer term versions, longer term charts, in the form of percentage base. Yeah, if you could elaborate on what you mean by that, that'd be excellent. So there was also an interesting one on the dollar yen. Guys, if you follow my analysis, you would have seen this from the monthly time frame on the dollar yen. We are bouncing from a descending resistance turn support. This is the monthly. This is a longer term chart, so it only needs to be looked at, every once in a while once you have your levels plotted. Okay, on the daily time frame, we have a long term. When I say long term, I'm talking reasonably long term. Back to 2019. 1 second, guys. Yeah, back to 2019 of May, and we had a reaction off this level. Okay, we have a question. What does the Dixie have to do with the euro dollar? So the Dixie is, as I said at the beginning, it contains the euro dollar, right? And the euro dollar, sorry, excuse me, not the euro dollar, the euro currency, the single currency, contains the largest weighting within the Dixie, and that's the US dollar index. So with that, we know that there's going to be an inverse correlation. So when the Dixie rallies, we tend to see a drop in the euro. So please do keep an eye on that. So I hope that's explained it reasonably clearly. So look, as I said, we've got a longer term resistance on the dollar yen, and we've seen a mild pullback, retracement. But what I did want to highlight here, because it was something that intermediate traders might have also seen. I'm not sure. Let me just get my notes up for this. So look, what I said in my analysis, for those who read Monday's technical report, you may recall the following. So demand at 109.02, 109.20. This was a decision point to initially break the, I think it's the 109.72 tops around this point. So this for me was an interesting demand area, and also it was a fresh area as well, because we haven't pulled back yet. We haven't retested the level. So this to me was a fresh demand. And given we're coming off a monthly level, we also had some higher time frame confluence. Anyway, this wasn't what attracted me to this level. What did attract me was the higher low that formed at 109.33. Now, guys, I'm just pointing out some things to watch on charts from a psychological standpoint. And so, look, the 109.33 higher low formed, and we formed another higher high at 110.33. Now, given the trend is reasonably high at this point, the medium-term trend is higher. We formed higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. Higher lows, higher highs. Now, with that, what do you think buyers, what do you think traders would have been doing at this point here? They'd have been looking to buy, wouldn't they? They'd have set the Fibonacci retracements up, buy, 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 buy. What happens is, and where do they place their stops? Either beyond this peak here. Let me just enlarge that chart. Let's see. So they'll be looking to buy at these points, right? After a higher high is formed, we're looking to buy, right? And a lot of traders would have placed their stops, protective stops below these points here and these points here. Now this is where it gets a little bit tricky for some people, because they've not looked at the charts from an order flow perspective, and this is only my perspective, guys. So do let me know if you think I'm wrong or I'm right or anything like that. We're all here to learn, right? So as I said, the protective stop loss orders would be beyond the higher low. Knowing this, and by identifying this demand, we could see a potential stop run. This is what I wrote in the previous analysis. And it's not always correct. This is just one instance where it did work out. It's worked out very, very nicely. So slipping through 109.33, and I'm talking about this higher low here, slipping through this area here, not only triggers buyers' protective stop loss orders, which are sell orders, right? Because if we're looking to buy, we need to sell to get out of the position. The move also filled breakout sellers' stop orders. And when I say sell stop orders, I might add, and what this does is collectively fuels moves into the bids at this demand. Okay, at this demand. Remember, bids and offers represent liquidity, and market orders attempt to consume liquidity. As you can see, price touched gloves. Price touched gloves with this demand area and has rallied. So what I can see from this chart is there was some heavy bids. Well, there clearly was some heavy bids here. And the reason these bids were plotted here, because they know that there's stops below here. They know that there's, I don't like to say liquidity, because it's not liquidity, these are market orders. So we need the market orders to fuel these bids. So the market orders move into these bids, and these are going to be some large traders here that will overcome or overthrow any sell orders at this point. But this provides the fuel to move these bids. So look, as we can see, price has rallied, and we also had a small H4 demand located within that area. This is more of a whipsaw demand. So we have a whipsaw up, down, and this is an area I would have looked at. I did actually highlight in the analysis, and if you can see, price did touch it to the pip and has so far rallied. So my upside target for this in my analysis was the 100 period simple moving average, which currently stands at around 109.70-ish. So it'd be interesting to see if that hits. We also had RSI bullish divergence supporting this move as well. Okay, any questions on this chart? Okay, we have a few questions. After the currency pairs you're focusing on, could you please show how you would apply the extension and retracement? Oh, sorry, Sean. Yeah, of course. On BTC, please, as opposed to line and arrows you showed. Yeah, Sean, I'll do that right now, actually. BTC, so Fibonacci extension and retracement. Would you like me to go over all the fib levels that I highlighted at the beginning? I can do that quickly on the BTC chart. Yeah, okay, cool, I'll do that. So forget this for now. So I'm going to draw it on if that's okay, or I can draw it on the chart actually. Right, so most of us understand what a Fibonacci retracement level is, right? So we have the higher high, higher low. We ping this from the higher low here to the higher high at this point here. And that, as I said, that springs across. Let me just, as I said, the 50 is not really a Fibonacci level, but it does help react. And as you can see, it pings out, it defines the Fibonacci retracement levels. So, as you can see in this instance, we reacted off the 50 level. Okay, we have someone asking for a webinar on supply and demand. Okay, that's a really good idea. What we'll do is we'll try and get something up and running for a supply and demand webinar. Would you like me to include the psychology around the supply and demand zones? I'm not talking about the actual supply and demand zones. I'm talking about the chart psychology before the area is hit. Very similar to this dollar-yen area here. Just to be clear, guys, this is my own way of looking at charts. Since for the years that I've been looking at charts, this is the things I've noticed that have worked for me. Yes, so look, I'll happily do that, but it's quite an advanced. It'll be quite an advanced webinar. So yeah, okay, cool. There's a lot of people asking for that. Excellent. All right, we'll get to that. No worries. So look, Fibonacci retracement. Fibonacci retracement, pretty simple, guys. 2 points: high, low, higher, high. The same for a downtrend, right? Point A, point B, and we have the fib retracement. Look, I'm sure most guys understand what the fib retracement is. That's the basics, isn't it, guys? So look, it's the extensions. So I'm just trying to, right, okay, so imagine we plot our fib retracement tool at this point here. I'm just going to get rid of some of the areas just to help it easily understand. These are the 2 key points I normally look at anyway, the 38.2% and the 61.8%. Now, at this point, people are going to be looking to buy, probably looking to buy off these areas here. But what happens is price drops through it, doesn't it? Now, we're looking for an extension of the Fibonacci retracement tool. So by doing this, we simply click on the 127 and the 1618. So with this, we have the extension of the, let me just get rid of them. As I said, 2 points again, from the higher low to the higher high, and we now have extension points to look at. Look, in this case, it didn't give anything, right? It didn't help, but you should always look for these in confluence with other levels. So the extension is simply a retracement. An extension is simply an extension of the Fibonacci retracement tool. Nothing more. Nothing more. I will highlight that in patterns such as the 3 drive. I'm sure some of you guys have heard of that. The 3 drive bullish and bearish patterns. The extension, the 127.2% extension, is very, very important. And the 61.8% Fibonacci retracement is also very important. Look, guys, but I'm actually doing a webinar on chart patterns this Thursday. So be sure to register for that, where I'm going to go over everything, most of the common chart patterns, so the flags, the pennants, and the textbook ways of analyzing charts through that. So, guys, we all clear with the Fibonacci extension? I hope so, because it's simply an extension of the retracement tool, not an extension of price. Next up, we have the projection. So I'm going to use this point. Bitcoin's not the greatest for this. So I'm going to start from this. I'll start from this point here, or I'll start from this point here. Okay. Look, from this point here, a projection requires 3 points. As I said at the beginning, from this point, so from the higher low to the higher high to the subsequent higher low. So as you can see, we didn't even reach the 100%. We didn't even reach the 100% fib projection. So look, it didn't reach anything. So, but look, the main point is 3 points for the projection: higher low, higher high, higher low, and we extend these levels to the upside. There is QM in the chart. There was a QM here that reacted, as I pointed out in my QM session before. The QM was here, and we got a lovely reaction off this point here, which hasn't derived much upside. Well, enough to get out with a handsome profit, but not great because we was also forming a bearish pennant. Okay, so finally we have the expansion. And if you can remember, the expansion contains just 2 points, and we don't actually need the higher the retracement to form. So let me try and find an example of this. There's no example on here. So if I just remove these drawings, just hide them. I don't really want to remove them, but right. If we just imagine that hold on, let me try and find an example for you guys. Okay. Trying to find a clear example. Okay, let's just use this example here. I'm sure you guys can see it. Right, from this area, this point here, the high low, we simply extend to this point here. The this is not really a higher though, is it? I'm trying to find a good example for you guys that won't confuse you. So imagine this was a high, price come up to this point here. So we draw this point. So we've drawn from the higher low to the higher high, and we've extended price back to the point at point B. Now, as you can imagine, this is 100% of the move. So to extend to form the expansion levels, we simply click on the one spot 27.272, the one spot 618% levels. And as you can see, these are the expansion levels. 3 points. I said 2 points in the at the beginning, right? But I did say that it's essentially 3 contact points, I guess, because you're extending from this point to that point and back to that point. So we have the one spot 272 and the one spot 618. In this case, guys, we didn't get anything. There's no reaction, was there? I hope that's cleared it up for you guys. I'm more than happy to touch on this again in future webinars. As I said, I'm back with you guys on Thursday with the chart patterns. Let me just spring back to the screen. So time has run out. I really do hope you guys have got something from this. I know I didn't go fully into my technical approach, but I feel that it'll be very difficult to do this over one webinar. But I hope you can understand that I focus on the Dixie first. I look at that. I always look at the dollar index, where we are in terms of where the dollar is positioned technically. And then I look at the 4 major currencies: the euro dollar, the Aussie dollar, dollar yen, and pound dollar. But I also do look at risk sentiment as well from the E-mini S&P futures, the VIX, and the yeah, no worries, guys, and the US government bonds, the US 10-year I look at. Yeah, good, Kevin, excellent. Any questions on the technical analysis on the website? We also have another guy on there called Gary Burton. I'm sure most of you guys have heard of him. Awesome guy, awesome at his job, really good at technical analysis. He's a veteran, in my opinion. So do check out his stuff. He does a weekly report on major instruments, and he really goes into detail with the technical analysis. So please do check out his stuff as well. There are 2 E-mini. There's a question here. There are 2 E-mini futures contracts. Yes, there is. There's a front month, and I think it's called the back month. So on the E-mini, so for me, I would always look at the ES1. That's the front month contract, which is the closest to expiration. They call it the spot month. That's nice, Andrew. Thank you. That's good. I'm glad everyone's learned something. Look, as I said, Jim, someone's asking about my daily routine. My daily routine largely consists of, as I said, is the Dixie. Look at the Dixie where we are positioned in the dollar, and I'll look at the 4 major currencies. I don't go crazy with the. I don't have tons and tons of charts, tons of asset instruments I look at. FX pairs. I just focus on the 4, and I find enough. I find that I understand these 4 very well in terms of order flow and things. Okay, so guys, any questions that I've missed or anything you want to touch on? My email is, yes, thank you, it's already in there. If you have any more questions, please send them to marketanalyst@fpmarkets.com, and I'll get back to you with a detailed response. Look, guys, I will be doing another live session in the future, next month, I believe, along with Isaac. So yeah, Yeah, so we'll go over this in more detail. I hope you've got some more information about the fibs. And as I said, any questions, please do fire them over to me. Thank you very much and have a lovely day. Thank you. Goodbye, guys.